As we look ahead to 2026, investors are asking whether the resilience we saw through a choppy 25 can carry forward into the new year, despite economic uncertainties. Here to weigh in is Invesco Chief Global Market Strategist Brian Levitt. Brian, happy holidays.
Happy holidays to you, Jack.
Thanks for coming in here.
My pleasure.
All right, so part of the theme of this show is big surprises in the new year. So what's your biggest surprise for markets and investing in 2026?
I think things are going to be resilient. I think the economy is going to be resilient and the market's going to be resilient. And why is that a surprise? It might not sound like it because it is in most years. You just hear a lot of negativity, a whole boatload of things, whether it's AI bubbles or lack of independence of the Fed.
4 years in a row is impossible.
Can we really do 20%? And I actually think, people are so focused on this artificial intelligence trade. I would want people to, maybe the big surprise is that the last couple of years about who's going to bring artificial intelligence to us, the next year is going to be about who's going to benefit from all of that.
All right, and your biggest investment idea for the year will probably surprise some people, although if they've been watching carefully, it isn't a surprise. But tell us where you think the most exciting place to invest is in 26.
I believe in the recovery trade. So the recovery trade will take you into things like emerging markets, will take you into small cap stocks. And one of the things about small cap stocks, investors have been looking, why can't they move down capitalization and perform well for a long period of time? It's because there wasn't really a catalyst. There wasn't a pickup in economic activity. There wasn't Fed easing, and we're getting both now. Now, it may not feel like it to everyone, but in actuality, leading indicators of the economy are picking up, and the Federal Reserve is committed to lowering interest rates. Both of those historically have been catalysts for smaller capitalization stocks.
Now, what about emerging? I mean, they've gone nowhere over a fairly long period of time. I think people just assumed it was dead money, but in the second half of 2025, it's starting to look pretty good.
And a lot of the reason why they went nowhere is we'd been in a very strong dollar environment, and part of that strong dollar environment was the fact that the Fed never was really in a gradual easing cycle. They were either tightening policy or lowering rates to zero in order to fight off crisis. So this is the first gradual easing cycle we've seen in a very long time. During gradual easing cycles, emerging market central banks can also bring interest rates lower, and we've started to see that. That's good news. And so the valuations are attractive. There's a catalyst. And if you look historically, which part of the market does best if you're in a modestly declining U.S. dollar environment, that's the emerging markets.
Yeah, you guys put out a chart about that. That is very interesting. And I guess there's also a technical reason, right, where if emerging market bonds are priced in dollars, then that
also helps.
To them.
Yeah, absolutely.
Alrighty, so speaking of bonds, the market is expecting a couple rate cuts this year. I don't think that's controversial. But where do you expect the longer end, say the 10-year bond, how do you expect that to behave next year? And importantly, for either people who are homeowners or want to buy a home, where are mortgage rates going to go?
I might not have great news for people who are looking to buy a home. If you think about the 10-year rate, we were in a pretty big range this year. So the middle of January, 480. More recently, we were below 4. And so I would say when you're at 480, you're oversold. When you're below 4, you're overbought. The answer will lie in the middle, and the answer should be a reasonable expectation of what nominal growth in the country would be. So if you consider 4.25, 4.5, that seems like a reasonable range for the 10-year rate. The challenge is that the mortgage rates will be set above that. And so investors hoping to see, or homeowners hoping to see, a 4% or a 3% mortgage rate, that's probably not forthcoming.
When you say nominal, you're saying maybe 2% GDP growth plus a little bit of inflation, and that gets you around that point?
Yeah, correct. And if you normally you would say 2% and 2%, right, but because inflation is going to run a bit hot here, 2.5% inflation seems reasonable.
Right. This will all play in, of course, to the midterm elections. The prediction markets say the Democrats take the House, but the Republicans hold the Senate. Do you agree with that? And if so, what does that mean for the markets?
That seems like the most reasonable outcome. And as you know, Jack, that's how we do things in this country. We give a party single party rule for a couple of years, then we seem to take it away from them. Yep. So the most likely outcome would be the same. In terms of what that means, probably means the big signature legislative accomplishments of the second Trump administration are likely over. There may be some things that could be done on the margin in a bipartisan fashion or executive order, but for the most part, you're looking at a divided government, not a lot happening. Historically, the markets seem just fine with that.
All right, we're just about out of time, but I will ask you, Jamie Dimon referred to the cockroaches in the private credit market. Are you worried? Are we going to see a blow up next year?
I'm not expecting to see a blow up. And, so far since that date when Jamie Dimon mentioned the cockroaches, we haven't seen a bunch more cockroaches. Fundamentals continue to look good. The spreads in private credit continue to look attractive. You want to be selective, right? You want to make sure you're selective, but it doesn't seem as if there's anything big lurking that's going to bring down the system.
We will have you in next year, and we'll do a checkup and see how it's going.
I very much look forward to it. Thank you.
Brian Levitt, thanks so much.
Thanks.